So you've got $1,000 just sitting in your bank account. I've got some news for you. And it might not be what you want to hear. You're actually losing money. But don't worry, today we're going to walk through a super simple, no jargon, 5-step blueprint for exactly how to invest that first $1,000 in 2026. And hey, this is for you even if you've never, ever bought a stock in your life. So let's just ask it straight up. Is that cash you worked so hard to save actually shrinking? Well, sad to say, the answer is a big yes. Let me show you what I mean. You see, here's the hard truth. There's this silent force out there called inflation, and it is constantly, day after day, eating away at the power of your money. So every day that your money isn't out there working for you, it's losing a little bit of its value. This really makes investing less of a nice to have and more of an absolute necessity, just to keep up. Now, I know what a lot of people are thinking. They get totally paralyzed by this fear of making a mistake, of picking the wrong thing. But here's the secret. The single biggest mistake you can make isn't choosing the wrong investment. No, it's waiting on the sidelines, waiting for that perfect moment that never comes and never getting started at all. All right, so before we even think about stocks or mutual funds or any of that, we need to talk about step 1, which is all about building your financial shield. This is non-negotiable. You have to secure your foundation before you put your money into the market. And that shield has a name. It's called an emergency fund. I want you to think of it like a cash buffer for all of life's unexpected curveballs. A sudden car repair, a surprise medical bill. This money is not for investing. It's for peace of mind. It's the thing that keeps you from having to sell your investments at the absolute worst possible time. So your very first goal before anything else is to get between $500 and $1,000 into what's called a high-yield savings account. Why there? Because unlike your regular old checking account, places like Ally, Marcus, or SoFi are paying really solid interest rates right now. We're talking 4 to 5%. Your money stays totally safe, you can get it anytime you need it, and it's actually growing. It's literally zero-risk free money. Once that's taken care of, you are ready to invest. Okay, with your safety shield firmly in place, it is time for the exciting part. Steps 2 and 3 are where we actually choose our tools and build the engine for your financial growth. This is where it gets fun. Step 2 is all about deciding where you're going to invest. And in 2026, beginners have 3 fantastic types of platforms to choose from, and each one has its own vibe. So you've pretty much got 3 main options. You have traditional brokerages like Fidelity and Schwab, which are amazing for long-term control. Then you've got the super simple apps like Robinhood and the automated set-it-and-forget-it robo-advisors like Acorns. Now, for your first 1,000, I strongly recommend a traditional brokerage like Fidelity. Why? 0 commissions, and they offer something called fractional shares, which just means you can buy like $10 of any company you want. It gives you maximum flexibility as you grow. And now for step 3, what do you actually buy? Please hear me on this. Do not try to pick individual stocks. You just don't need that stress in your life. Instead, we're going to build a dead simple but incredibly powerful 3-fund portfolio. People sometimes call this a lazy portfolio, and let me tell you, it is amazingly effective. Here's exactly what it looks like. We're going to take that $1,000 and we're just going to split it 3 ways. 60%, so that's $600, goes into a total US stock market fund. 20%, or $200, goes into an international stock fund. And the final 20%, another $200, goes into a bond fund. That's it. It is really that simple. So let's break down why this little combo works so well. That first $600 in a fund like VTI, that's your engine. It gives you a tiny piece of over 3,000 of the biggest companies in America. The 200 in VXUS, that diversifies you across the whole globe. So you're not just betting on one country's economy. And that last $200 in BND, that's your stabilizer. Bonds are kind of boring, I get it, but they provide a crucial safety cushion when the stock market inevitably has a bad day or a bad year. And hey, if you're still a little skeptical, if this sounds too easy, don't just take my word for it. The legend himself, Warren Buffett, has said that for the vast majority of people, a simple, low-cost index fund is the single most sensible investment you can possibly make. You see, you're not trying to outsmart the market, you're just matching its performance with almost 0 effort. Okay, now we get to the secret sauce. This is the good stuff. Step 4 is where you put your growth on autopilot by tapping into the magic of consistency and compound interest. So once you've invested that first $1,000, the real key is to not stop there. What if you could find a way to just add $100 more each month? I know it might not sound like a lot, but just watch what happens over time. Yeah, $100 a month might not feel like you're moving mountains, but over 30 years, thanks to the unbelievable power of compounding, it can turn your initial investment into over $122,000. You can see it right here. The growth starts off kind of slow, but then it just accelerates like crazy. In those first 10 years, you build up to about 18 grand. But in the last 10 years alone, that amount more than doubles. That's your money making money for you. The whole key is to set up automatic monthly investments and then just let time do all the heavy lifting. And that brings us to our final and maybe the most important step of all, avoiding the traps. Because look, setting up the portfolio, that's half the battle. The other half is mastering your own brain to stay disciplined for the long haul. Here are the 3 biggest traps that get beginners every time. First, don't try to day trade or jump on the latest meme stock. You're not going to outsmart Wall Street, I promise. Second, do not, I repeat, do not panic sell when the market drops. And it will drop, that's normal. Selling in a panic just turns a temporary paper loss into a permanent, real one. And third, ignore the hot tips from social media. Just stick to your boring, simple, and incredibly effective plan. You know, at the end of the day, success really comes down to this fundamental mindset shift. You've got to go from trying to time the market to focusing on time in the market. Go from reacting to every scary headline to just sticking with your plan. And go from seeking those quick, risky wins to patiently building sustainable, long-term wealth. So that's the blueprint. It's simple, it's proven, and it's absolutely something you can start today. Which really just leaves me with one final question for you to think about. What's your investing goal for 2026? Now go make your money work for you.